Hey everybody, 2024 is rapidly coming to an end, and for the most part, it's been a really great year in the stock market. As we're recording this, the S&P 500 is up by about 30% year to date. This is as of December 12th, and most of the stock, not most, but more than half of the stocks in my portfolio are up by 30% or more this year. It's been a pretty solid year after a pretty dismal 2022. 2023 was a decent rebound, but this year has been very good. But it's also important to not only examine our winners, which we are doing in a different video, but to take a look at your losers and why they haven't been performing well, and see if you're just check in, make sure your investment thesis still applies and things like that. So before we dive in, take a look at fool.com/Frankel. The link you see on your screen right now, you can get the top 10 stocks from the Motley Fool. Best way to support this work we are doing here on YouTube. Again, fool.com/Frankel. So on one hand, when I was looking at this, I had to look up what my worst performing stock was because I know I have a bunch of real estate stocks that are down, 5 to 10%, things like that. I was actually pleasantly surprised to see that my worst performing stock was only down by 16% this year. In 2022, I could just tell you that wasn't the case. I'm sure the same with you, Tyler. I'm sure in 2022 and even maybe in 2023, there were stocks in your portfolio that were down a little more than 16%.
I think I was actually one of the weird ones who went the other way.
Well, I mean, that's your style.
Yeah, I was one of the weird people who made a lot of money in 2022 because I was heavy energy.
There
and
you
then
go.
2023, 2024 have not been as promising for me.
Fair enough. So I'll get right to it. My decliner down 16% in 2024 is Pinterest. Ticker symbol PINS. And a couple of things to note. 16% down does not sound that bad, but when you compare it to the S&P 500, it is underperforming the benchmark by 46 percentage points. So that makes it sound significantly worse. And number two, Pinterest was one of the better performers until two straight post-earnings declines. In fact, it was down about 15% after the third quarter earnings report. So until then, it was roughly break even on the year, and now it's down 16% for the year. As I mentioned, this is the second straight earnings report where it's dropped, and it's the second straight earnings report where it's dropped specifically because of poor guidance. So there's a lot to like about Pinterest business right now. It has 537 million monthly active users. That's an all-time high. Its revenue is growing by 18% year over year. That's very solid. New management's done a good job of, boosting engagement, boosting the user base, and it's profitable. It produced better than expected net income for the quarter. But there's a lot not to like as well. One thing that really stood out as a red flag to investors, Pinterest ad pricing, it plunged. It declined by 17%. There was far more supply of ads, meaning available, ad impressions on the site than there was demand. Revenue grew overall because the volume of ad impressions on the site was up 41%. As a social media company, and I mean, Tyler, I don't know how much you're on social media, but I'm on a little bit. You don't want to be bombarded with ads. So basically, the strategy they used in the third quarter to boost revenue was to just show people 40% more ads. My fear is that can annoy your customer base over time and have the opposite effect of reducing engagement. But we're getting into the fourth quarter. So far, the holiday season in terms of shopping has been better than expected. So my hope is that this trend will reverse. But Pinterest fourth quarter guidance did come in kind of soft. Now, in 2025, what I'm watching, Pinterest did implement a new $2 billion buyback plan, which is a fairly aggressive amount. And the fact that the stock's down makes me kind of encouraged by that. Like I said, I'm going to be watching the holiday quarter numbers closely when they come out early in 2025. And a stronger economy in general means more ad revenue. So this is really an economically sensitive company, more than you might think. If the economy is stronger than expected in 2025, Pinterest ad revenue should be strong. If it's not, then the opposite should be true. So that's my worst performer this year. I've actually added to my position recently, in full disclosure. So it is still one of my largest investments, and I'll be watching the next earnings report closely, but I'm still very bullish on Pinterest. Tyler?
So I kind of had this small handful of companies probably down somewhere in the 20 to 30% range. Like I said, I tend to be pretty heavy industry, commodities, energy, things like that. But the one that actually stood out to me, and this is a company that like has been a very, very long-term compounder, one of those businesses you just kind of sit back and just let the management do its work, and that's a Nucor. It's one of the largest steel mills in the United States, steel producers, as well as doing a lot of like finishing products, things like that. And it's down about 23% for the year, which, like you said, when you compare that to, the gain of the S&P over that entire time, that starts to look pretty stark. And look, I mean, it's no surprise that the steel industry is a little bit cyclical. There has been the pricing for steel has gone down significantly. Automotive tends to be one of the largest end markets for steel in the United States, especially because it's also a higher price, higher quality steel because it's like it versus like construction steel. It has to be a little bit stronger, a little bit lighter, a little bit more malleable for automotive customers, higher performance, higher prices. But the automotive production in the United States has been a little weak in the past couple of quarters. Kind of that big ramp up for electric vehicles has started to wane. And so we're starting to see a slowdown in overall vehicle production, which of course is having an impact on steel pricing in general. It's one of the things that Nucor has talked about is lower steel pricing. But one of the things in a company down 20% in a year where the market's gaining 25 could be concerning and be like, man, what could go wrong? But one of the things that Nucor has done spectacularly well over the decades that it's been in business is it invests counter cyclically. So often when the industry starts to go south, you see this is a company that starts to invest heavily. It starts to do things like either expand capacity or kind of move into different parts of the value chain, either further up into kind of like we call it reducing the your iron oxide that you get from the mine down to a product that you can use in your mills, or you get into finishing things where you start making components and things like that. And that's where Nucor it tends to like branch out onto either side of the supply chain for steel during downtimes. And that's exactly what management said. It's going to start to bump its capital expenditure budgets in the coming years because it sees a little bit of market weakness and sees an opportunity to kind of take market from probably some of the weaker players in this industry. Yeah, as far as the stock right now, this is where it starts to get a little peculiar for me. It's like, even though it's down like 20%, the market's done really well. One of the things that I've always tended to use as a gauge for value for Nucor is its dividend yield, because it's cyclical, because of things like that, using things like PE or price to per price of earnings or price to free cash flow, that can be really challenging. And we've talked about this before, but in cyclical industries, typically when it has a really low PE, that typically means that it's like peak of earnings cycle and it's about to head down, things like that. And so dividend yield tends to be a pretty good proxy because you can kind of like base it on its history. And with its current dividend yield right now is about 1.65. And historically speaking, we're talking about a business that has had a yield considerably higher than that. If I were to go over the past 15, 20 years, this is a business that typically trades closer to like 2.53%. So there's part of me that says maybe it's still expensive to buy more today, but it's certainly not a stock that I want to be selling anytime soon. And so it's an interesting case study for me because we talked about this before the show. We've had these companies we talked about just 100% gains, 150% gains, and a lot of them are very like, we'll call them more speculative businesses, maybe ones that aren't quite profitable yet, but the future and their growth looks absolutely spectacular. Those have been some of the biggest winners so far this year, in addition to the mega cap like NVIDIAs of the world and things like that, which are immensely profitable. It's like this barbell approach of like the most speculative and the best companies to ever exist. And then there's like this large middle of like kind of the older economy things that still make a lot of money and are good operating businesses. But from a stock performance, it's been pretty lousy this year.
I want to thank The Motley Fool for sponsoring this video. The Motley Fool is a company that provides investing insight and stock recommendations for investors of all skill sets and risk levels. You all know how much I love researching new stocks and trying to find the next best investment. So I'm proud to partner with The Motley Fool to bring you 10 stock picks from the popular product Stock Advisor. Stock Advisor has beaten the market by nearly 5 times. So go to fool.com/Frankel to get your 10 stock picks now. The Motley Fool Stock Advisor returns are 767% as of July 5th, 2024, and are measured against the S&P 500 returns of 163% as of July 5th, 2024.